Okay, let's begin our today's class, tutorial 7, on the equity markets, on stock market, on stock valuation. Okay, so that's what we're going to look into for today's class. Okay, so first of all, three things that you need to know in this tutorial itself, in this topic itself, which is the three things that are highlighted over here. Zero growth method, constant growth method, and non-constant methods. Okay, first of all, right, now let's have a look into the first scenario before we look into any of the contents first. Now, assuming we look into a situation in which we call as finite holdings. What is the meaning of finite holdings? Finite holdings means today you buy a stock, but you only hold it for a period of time. That means that you will sell it out at the end of the day anyway. So assuming today we look into a situation in which you hold a stock for a limited period of time, okay, like for example, if let's say you hold it for 1 period, okay, and of course in that 1 period you will get your dividends, and at the same time by the time you sell out you will get back the money, the amount. Okay, if let's say it's 1 period, you will just use back the same PV formula. Okay, you just use back the same PV formula in which you key in your future value, your interest rate, your N, and your you compute your present value. Okay, so that is a normal scenario, a recap of what we have learned to calculate how to calculate the PV value. Now, another example, if today I hold the stock for 3 years, for example. So in year 1, I will receive this amount of dividends of my cash flow, and in second year, I receive this amount. In third year, I receive this amount, and then by the time I sell out, I get this amount again. Okay, so if it's a finite period, okay, a limited time, again, I use back my present value formula. So if you use calculator, you key in your cash flow value, like the cash flow in year 1, cash flow in year 2, and cash flow in year 3, and then press your NPV to key in your interest rate and compute NPV. So you see, if you hold the stock for a period of time, you are just using back on what we have learned before to calculate the present value of the stock itself, okay, of the stock that you purchase. Okay, so that's how you calculate present value, right? Same thing of what we learned. But what if today we refer to a situation in which we call as infinite holdings? That means I buy the stock, I hold the stock, but I'm not sure when I'm going to sell it out yet. I want to hold it for infinite, okay, for infinite period of time. Okay, so first of all, if today I want to calculate present value, you see, what we learned is that present value, okay, is basically you what we call as you discount all the dividends or all the payment that you get in the future and discount back to calculate the present value, right? So therefore, like for example, just now we talk about the finite holdings. Okay, so we look into the present value of all the future dividends. Okay, so same thing, if today I were to look into the scenario in which we call as infinite holdings, that means I want to hold for infinity amount of time. Okay, what are the methods available for us to calculate? Now, there are 3 methods over here for 3 different scenarios. For example, let's say we look into the first scenario, we call it as zero growth method, or we call as a constant dividend forever. So for example, let's say you purchase a stock, okay, you purchase a share, okay, then what happened is this one, you will be given the same dividends forever. Same dividend forever. Okay, so therefore this is like the perpetuity formula that you learned before. Okay, so perpetuity formula, you use your cash flow divided by interest rate. So to calculate the present value, the present value of this stock, you just use the dividends divided by interest rate. So this is basically using the perpetuity formula. Because why? Because you are getting the same dividends forever. So if I were to calculate this present value, I'm just using back the perpetuity formula. So this is like the preferred stock. Also, preferred stock is like once you purchase the stock, whether the company earns money or not, they will still pay you a certain amount of dividends, the fixed dividend forever until you sell it out. Okay, so if it fulfills these characteristics, then you will use zero growth method to calculate it. Okay, now second scenario, okay, here we say that constant growth methods. So that means that we assume the firm will increase the dividend by a constant percent every period. So the dividend is no longer fixed, but it will grow. But the thing is this, the growth rate is fixed here. That means you know how much it grows every year over here for this second scenario. The dividend is not fixed, the amount is not fixed, but the growth rate is fixed. Okay, so therefore we'll use constant growth method. But of course, this is arguable because it looks unrealistic. How can you ensure that the growth rate can be consistent, can be the same every year? It is hard to achieve that. It is unrealistic. So therefore, this method only applies theoretically, but it is hard to apply in practical. Okay. Now, I want you to remember two assumptions. These two assumptions is very important. The two assumptions that must fulfill before you are able to use constant growth method. The first one is first, dividend will be paid forever. Okay, it will be paid forever, but the thing is amount is not always the same. Okay, second, a constant growth rate of dividends occur forever. That means the growth rate is constant. Okay, so like for example, this scenario that you can see on the bottom here. Okay, you can see that every year you will get these dividends, but these dividends over here will be different amount. What is same is only this growth rate. Okay, D here stands for my dividends, in which you can consider as your cash flow. Okay, so how do we calculate the share price? The P0 over here is the present value of the stock, or you can call it the share price. How do you calculate this? So we will use this formula. P0 equals to the D1 divided by required return minus the growth rate. R here stands for the required rate of return. Okay, G here stands for the growth rate. Okay, D1 over here is my dividend. Okay, D1 means the dividend that I received in year one. Okay, now sometimes they might not tell you what is the D1 amount. So remember, when I say D1 means that the dividend that I'm going to receive in future, what is being expected to pay by the company. When I say D0, D0, D0 means the dividend that has just been paid. Okay, so it's not part of our valuation anymore. So therefore, when we want to take, we take D1. But the thing is, sometimes they might not give you the D1 figures. So you have to calculate by yourself. So they will give you D0. So how to calculate D1? You have to use D0 bracket 1 plus G. Okay, if you want to calculate D2, you use D1 bracket 1 plus G. Or you can use D0 bracket 1 plus G power of 2. So here you learn two formulas. Okay, one is this one and one is this one. Two things here. Two options for you to calculate the dividend, which you are going to use it later on. Okay, so if only if they fulfill these two assumptions, as you can see here, then only you can use constant growth method. Now the third method is called supernormal growth or non-constant method. That means that here the dividend growth is not consistent anymore. Okay, it is not consistent initially. Okay, so that means in year one you will receive an amount of dividend, in year two you will receive another amount of dividend, and in year three you will receive another amount of dividend, and the growth rate are not same. Okay, are not same initially, but later on it will settle down to constant growth rate eventually. Later, after a few years, then only it will settle down, then only follow the consistent growth rate. Okay, so how you're going to compute. This is what we're going to look into later on, in which this is the one that you will be assessed the most. That means it will carry the highest weightage in the 20 marks questions. Okay, so now, before we look into supernormal growth, I want to go through some more about constant growth first, because later on, supernormal growth, I will use one question to go through with you. Now, we talk about constant growth method. Okay, so, this one. Okay, so now we just learned this formula. Okay, so P, the price of the stock equals to D0 1 plus G, okay, divided by R minus G. Okay, or I can rewrite into D1 because when you calculate this one, D0 bracket 1 plus G, you are getting D1 over here. Okay, so that's the formula that you learn. Now I can rearrange this formula itself to find out where do I get my where do I get my return, because this out here means require return. Okay, so therefore I can play around with the formula and form this equation. R equals to D1 divided by P0 plus G. Okay, why I want to form this formula? Because R here means my require rate of return. So it's the same thing like today, right? When you are an investor, you buy the share of the company, okay? What kind of return that you're expecting? I'm expecting two sorts of return from the stock investments. One is from dividends and one is from capital gains. Okay, so this one itself, actually, you can see from this formula. From this initial formula, I move around to form the equation that start with R. Okay, so therefore R equals to this one. Now on the left hand side here, on this one, D1 divided by P0, this is your dividend yield that you learn in your chapter 3, the ratio. If you use the dividend amount that you receive divided by the share price, that's what we call as dividend yield, which makes sense, right? Because when you buy the share, when you buy the stock, you will expect, okay, the dividend amount they receive every half year or every year. Okay, another one is G. G here is the growth rate. That means that how much you expect the share price to increase, the capital gains. Okay, the capital gains here. Okay, so therefore from here, once I play around and move the term, okay, this form an equation over here in which my return from my stock investment is coming from my dividends and the capital gains. Okay, two things. Now, I want to see some relationship, okay? Some relationship between different variables. So like, for example, if I were to look into this growth rate over here, okay, let's say now I erase everything first. Now I want to see this growth rate. Okay, so I want to see the growth rate with the share price value. So therefore, since here at the denominator is negative, so negative, it becomes positive. So therefore, when the growth rate increase, this share price will increase. So therefore, the relationship between the share price and the growth rate will be a positive relationship. So the higher the growth rate, the higher the stock price, and therefore the graph is upward sloping. It's a positive relationship. So therefore, is upward sloping. How do I know? Again, I explain the formula here again for you. So if today I look into this growth rate and this share price, these two things, because this whole thing is at my denominator, right? So by right, when this increase, the whole thing will go down, right? But the thing is this, you have one negative over here. So therefore, when this increase, okay, when this increase, the whole thing will, this thing will go down, okay, and therefore the figure will become very big. Okay, I can understand, right? Okay, now on the other hand, if today I were to look into another two variables, okay, let's say now I would like to look into the relationship between the share price and the required rate of return. Okay, so therefore when this go up, since that one is under my fraction, which we call as denominator, and therefore this thing will go down. So the lower the share, the lower the share price, the higher the required rate of return. Okay, so this is a negative relationship in which is a downward sloping curve. Which makes sense, right? Because when the share price is low, that means you buy the share at a very low price and definitely you are going to get a high return, no? Correct or not? So therefore, when you understand this formula itself, same thing. You see, when the economy not good, when the companies when the economy not doing good and when the company is not doing good, the share price fall. Okay, so overall your dividend yield will go up. Like right now, economy is not doing good. So if you are holding any stocks, right, you realize that you're actually earning a lot from dividends because the share price drops. So when you calculate your dividend yield, your dividend yield is high. So make sense, right? So therefore, you see, it's very easy to understand this diagram as well, because when you buy the company share at a low price, definitely you are going to get a high returns, right? Okay, so now let's have a look into one question here to show non-constant growth. Okay, so this is the third scenario that we're talking about just now. Okay, so first of all, ABC Berhad dividends are expected to grow at a 20% per year for the next 2 years. Okay, so 20% for the first year and second year. Okay, and then at the end of the 2 years, ABC dividend growth is expected to grow 5% indefinitely. So from year 2 onwards, from year 3 onwards to infinity, it will grow 5%. Okay, and ABC has just paid 1.1, has just paid. So what is this? This is my D0. Okay, so I got D0, surely I can calculate my D1 later on already. So therefore, now I have to calculate my D1, D2, okay? And then after D2, right, what happened is D3 onwards, it will be the same, right? Because it grows at the same constant growth rate. So therefore, I can later on calculate the price from the year 3 onwards first. Okay, because why? First of all, what we are going to calculate? We are going to calculate the present value, the share price. We are calculating the share price over here. Okay, so share price is a bit like present value. And how do you calculate present value? Present value is basically you discount back all the dividends, all the cash flow that you receive throughout the time that you hold the stock itself. Okay, so you want to calculate, you want to discount it back to the present. Okay, so therefore, now later on, as we know, from year 3 onwards, or from year 2 onwards, okay, after year 2, from year 3 onwards, it will be the same constant growth rate. So therefore, we can straight away use the price of the year 3, okay, to calculate, to put into our calculation. Okay, so now let's do it step by step. So first, we can calculate the D1 first. Okay, so now D1, so I write here as well, D1. Okay, we use the formula D0 bracket 1 plus G. So D0 is 1.1 bracket 1 plus G. Growth rate is 20%, so is 0.2. Okay, then you put into calculator, you will get 1.32. Okay, so this one you get 1.32. Okay, moving on to D2. Calculate D2, do the same again. So now we have to use D1 bracket 1 plus G. Okay, then D1 is 1.32, 1 plus 0.2. Okay, and I get 1.584. Okay, so I put it here, 1.584. Okay. Now, after that, I want to calculate this P3 already. Because from year 3 onwards, it's going to be the same constant growth. Okay, so how? So you see, from P3 onwards, we call as constant growth. So which formula should we use? So if I move back, which one should we use? We should use the second one, constant growth rate. Okay, because it grows by the same rate forever. So therefore, what's the formula? This one, P0 equals to D1 divided by R minus G. But now we calculate P3. So how to calculate sorry, not P3, P2 actually. I should call it P2, not P3. So let me just change a bit because it's year 2. Okay. So put P2 because from P2 onwards. Okay, just the name only. Okay, so therefore, to calculate this P2, I will use my dividends in year 3 divided by R minus G. Okay, but the thing is this, I don't have D3 yet, so I have to calculate my D3. D3 equals to 1.584 bracket 1 plus 5%, so 0.05. Okay, so calculate it, I will get 1.6632. Okay, so that's my D3. Okay, so now I can calculate already. So this is 1.6632, okay, divided by required rate of return is 15%. Okay, 15%. So 0.15 minus the growth rate, which is 0.05, and then put that into a calculator, so you will get 16.632. Okay, that's the P2 value. So now I want to calculate my present value. I have to use this amount that I highlight in pink, this amount, okay, and this amount. Okay, so let's see how we are going to do. Okay, so same thing here. You use the NPV. So first of all, you press the cash flow, second clear work. Okay, you put CF0 equals to 0 as usual. C01 means the dividend they receive in year 1 is 1.32, right? So 1.32, and how many times you receive it? One time, so the frequency is only 1. Okay, and then C02. Okay, C02 in year 2 you receive this dividend plus this P2, right? Because from year 2 onwards, I mean, after year 2, from year 3 onwards, it will grow constantly already. So we need to calculate this P2 in. So I have to use 1.5x4 plus 16.632. So how much the amount? Let me calculate it as well. 1.5x4 plus 16.632. Okay, so you will get 18.216. Okay, and this is you receive one time as well. The frequency is 1 as well, and done already. Then you press NPV. Okay, you press NPV and then key in the the interest rate. Interest rate here means the required rate of return, which is 15. Just press 15 and then compute NPV, and you will get the answer straight away, which is 14.92. So that's the share price. That's the present value of the share. The share price of this stock itself. 14.82. There's answers. Okay. This is the kind of question that you will be assessed during finals. Okay, can let's move on with some theory stuff. Okay, some theories here. First of all, when we talk about stock value, what we have been calculating is what we call as stock value, or we can call it as intrinsic value. Okay, so like for example, if you get the answers 8.67, we'll calculate the present value, that is intrinsic value. Okay, now what you see on stock market is called stock market value. That means the price per share. Price per share means the current share price. Okay, the current share price. For example, it shows $10, then there's the current share price. So in this scenario, you can see that the current share price is larger than the stock value. Means what? Means this kind of company is being overvalued already, overpriced. Okay, because the share price in the market is larger than this amount. Okay, now we have two types of stock. One is common stock and one is preferred stock. Preferred stock, like what I told you just now, it is being, your dividend is being paid perpetually. Okay, so this one is perpetuity one. Okay, perpetuity. Okay, common stock is like the normal shares lah. Like the share that you buy from stock market, and then after that you only get paid the dividends when they earn money. Okay. So what are their features? So for example, if you are holding common stock, you have voting rights. One share, one vote. Okay. or like that sometimes they might have proxy voting. Proxy voting means that you can allow someone to actually work on behalf of you. Okay, so you can grant the authority to other people, to your friends, to work on behalf of you. Okay, even to another shareholder. So that's called proxy voting. And sometimes some common stock, they have different classes of stock. Like for example, like what you will purchase in stock market is the ordinary one. Okay, that means one share, one vote. But sometimes you may have some special privilege one. Like if you are some of the company's owners, then you might have some privilege. Like for example, one share you might have three voting rights. So having three voting rights per share. Why? Because they want to maintain the ownership of firms. So therefore, if let's say you have a stake in the business itself, so they wouldn't want the outsider to do so much of the decisions of the business. So for the share that you have, since you are part of the business owners, you will carry a higher weightage in terms of ownership. Okay, so these are the different level of voting rights that the shareholders have. But for preferred stock, there's no voting right. Okay, and dividends will be paid forever. Dividends will be paid, and every time when the company is not able to pay the dividends, it will be accumulated and paid in the future. So all the preferred stocks, all the preferred dividends will accumulative. So any missed amount will be paid in the future before common dividends. Okay, so these are the features of preferred stock. Now, another one last slide. This is the most important one. Please make sure you save it. The difference between debt financing and equity financing, which we roughly talk about that in the before in the front classes as well. A company can raise finance through different methods. One is through debt financing. Second is through equity financing. Okay, when I talk about debt financing, means we use the bonds. We talk about equity financing means we raise the finance through the issue of the shares. Okay, so what are the advantages and disadvantages? That's what you want to focus on. So when we talk about debt financing using bonds, the good thing is that there is no voting right. So that means that you can remain the ownership of the business. Okay, so there will be no transfer of ownership in firms. You will not worry that one day someone can take over your business, right? Because you remain to be the owner itself. And the good thing of using debt financing is that when you use debt financing, you have to pay interest, the finance cost. So finance cost itself is tax deductible. Okay, tax deductible. So it's good. Okay. Now the bad thing for debt financing is that they will have legal consequences if you are not able to make pay your interest or pay your principal payments. Okay, and if you are not able to pay, you might get into bankruptcy. Okay. And as for equity financing, okay, what happened is the good thing of equity financing is that dividends is not a liability. You only pay to your shareholders if only if you make money, unless you're referring to preferred stock. Okay, and you will not go bankrupt because there'll be no legal consequences if, let's say, you are not able to pay the dividends because it's not compulsory. Okay, the bad thing of this is that there will be a dilution of ownership because you worry that someone may, but sometimes you worry that maybe one day someone may buys too much of the shares of the company and take over your company, or maybe they have a decisions in your they might have a say in your decisions because they can vote, right? So therefore, they have the voting rights and therefore they can influence your decision making. And another thing is that dividends is not tax deductible. Okay, it's not considered as your expense. Okay, so these are the advantages and disadvantages of the debt financing and equity financing. Okay, so that's the thing you need to know for your uh tutorial 7. Okay, so now let's have a look into tutorial questions. Okay, first of all, first question, dividend growth model. Under what true assumptions? Okay, under what true assumptions can we use the dividend growth model? True assumptions that we can use the dividend growth model, the constant growth. Okay, so this one, the two answers that I highlighted. Dividends are expected to pay forever, and then the constant growth rate must be the same. The growth rate must be constant and occurs forever. Okay, there's the two things. Okay, question number 2, dividend growth model. Based on the dividend growth model, what are the two components of the total return on the share of a stock? That means when you buy a stock, what kind of two returns do you expect? Okay, two things, dividend yield and capital gains here. The formula that we talked about just now. Okay, so which one you think is larger? For most companies, the capital gain is larger. Okay, so this is easy to see for companies that pay no dividends. But for companies that do pay dividends, the dividend yields are rarely over 5% and often much less. So that means that usually you don't expect much from a dividend yield itself. Usually you earn more from capital gains. right? So that's why people always say buy low, sell high. Yeah. Okay, so let's look into calculation questions. Question 1. Okay, so Umbak Properties just paid a dividend of 2.53 per share on its stock. The dividend are expected to grow at a constant rate of 5.4% per year indefinitely. So that means constant growth rate. If investors require a 10% required rate of return on Umbak stock, what is the current price? And what will be the price in 3 years and in 15 years? So what formula you should use? Constant growth, Okay, constant growth method, Okay, so therefore, first of all, there are a lot of questions here. Okay, first of all, just paid. Okay, we say just paid means D0. This is D0. Okay, and then this is my G. Okay, this 10% is my R. I have 3 questions to calculate current price, 3 years in 15 years. Okay, so how do you do? So you see the formula here. So I have to use this formula. P0 equals to D0 1 plus G, sorry, D1, sorry. So I have to use the formula that we learned just now, this one that you see, D1 R minus G. Okay, so D1 R minus G. Okay, how do I get D1? Because there's no D1 being provided. So I have to use D0 bracket 1 plus G. It's proportion of R minus G. Okay, so D0 is 2.53, 1 plus G. G is 5.4%. So convert to decimal. Correct. Yeah. Okay. And then required rate of return is 10%, 0.1. Okay. Minus growth rate, 0.054. Okay. Put into calculator and what answer do you get? You should get 57.97. See if you can get these answers. So you in final exam usually you have one question asking constant growth, another one ask supernormal. Okay, so 2. Your span of attention very less. So easy to get distracted. What? Correct, the figures is correct, right? Okay, then continue. We need to calculate the price of stock in year 3. So how do we calculate the price of stock in year 3? So we use formula again. So if to calculate P3, I have to use D4. Okay, I have to use D4 divided by R minus G. But I don't even have D3. Okay, so how do we do here? So we have to use another formula. Which formula? This one that you see here, the one with power. You still use D0, but with the power here. Power of 4. The power of 3 is power of 4, yeah, power of 4, because I have to calculate D4. Okay, so therefore now okay, I can use D0 1 plus G power of 4 because I want to calculate the dividend in year 4. Okay, minus G. Okay, D0 1 plus 0 0.054 power of 4 bracket 0.1 minus 0.054. So you put into calculator and see what answers did you get. 67.88. Yeah, right. Okay, so you see, you straight away use formula. I think the workings written in your answer a bit complex. Actually, it's the same thing lah. Okay, maybe it looks easier to see from working. Okay, if I want to calculate year in 15, price in 15, same thing as well. P15 equals to the dividend in year 16 divided by R minus G. Same thing here, I do not have D16, so I can use back the D0, 1 plus G power of 16 because I want to calculate the dividends in year 16 and then as a proportion of R minus G. So therefore, D0 is how much again? 2.53. 2.53 bracket 1 plus 0.054 power of 16. It's a proportion of 0.1 minus 0.054. And then you put into calculators and let's see what answers do you get. You should get 127.59. Right. Okay, or alternatively, you can even use this formula that's being suggested in your answers over here. Like to calculate P3, they can straight away use P0 bracket 1 plus G power of 3. This one also can. This one also can. These alternative methods. But I will use by this one easier. Yeah, depends on you. Okay, can we move on? Yeah, we move on. Okay, next question. Calculate stock value again. Now the next dividend means what? D1. The next dividend payment by Lalita Singh traders will be 2.45 per share. The dividends are anticipated to maintain a 5.5% growth rate forever. If the stock currently sells for 49.50 per share, oh, now they give you the share price already. They ask you what is the required rate of return. So the balik lor. Okay. So first of all, we calculate required rate of return is R, right? So remember we learned the formula of R just now. I already moved the equation for you. R equals to the dividend yields plus the capital gains, right? So D1 as a proportion of P0 plus G. So D1 is 2.45 divided by P0. Berapa P0? P0 is 49.50. And then plus growth rate is 5.5%. Convert into decimal, 0.055. Okay, put into calculators. What do you get? You get 0.1045, and then you can change it to percentage, 10.45%. Ta-da! I get the answers. There's a required rate of return. As simple as that. Okay, next Okay, next question. Again, we calculate stock value. Okay, Zix Corporation will pay 3.85%, $3.85 per share dividend next year. So what is this? D1. Okay. The company pledged to increase its dividend by 4.5% per year. Okay, so that's what your growth rate, lor. So make sure you know what values are all these. If you can get the value, you can understand what value are all these, then you are very safe already. Indefinitely. If you require a 14% return on investments, how much will you pay for the company stock today? Wow, easy this question. You see also you know how to do already. Correct or not? So we use back the same formula. P0 equals to D1 as a proportion of R minus G. You got all the values. D1 is 3.85. So 3.85 as a proportion of required return 0.14 minus G is 4.5%, 0.045. Okay, and then put that into your calculators and you can surely get your answers ready. Easy peasy. Okay, next question. Okay, stock valuation. Again, suppose you know that a company stock currently sell for 65 per share. Currently sell for this price. This is your share price, lor. Okay, and the required rate of return on stock is 10%. This is your R. Okay. You also know that the total return on the stock is evenly divided. Evenly divided. The return is evenly divided between capital gains yield and dividend yield. Okay, so 50%, 50% lah. Okay, and then if it is a company policy to always maintain the constant growth rate in its dividends, okay, what is the current dividend per share? Okay, so now we assume that they maintain a constant growth rate in dividends. So what is the current dividend per share? Okay, so first of all, we just learn this formula. Remember this one, the required rate of return equals to the D1 divided by P0, which is my dividend yield, plus the capital gains yield. Okay, so this is the sentence. Right? So therefore, just now in the question, we say total returns, okay, total return is, or we call as required rate of return is 10%. And it is evenly divided. You see, evenly divided. Okay, so you have capital gains and dividends yield. Okay, dividends yield gain. So if I say the required rate of return is 10%, it is evenly divided means what? That means I earn 5% from capital gains, I earn 5% from dividend yield. Understand or not? Okay, so therefore, now I can calculate my dividend yield already. Why? Because I know my dividend yield is D1 divided by P0. So D1 is, I do not, okay, so I do not my D1. So let me write better. Okay, so I can rewrite the formula. Dividend yield equals to D1 divided by P0. Right? So dividend yield I know is 5%, which is 0.05. D1 I do not know. But I know P0. P0 is what? 65 per share. That's current share price. So put into calculator, D1 is 3.25. Okay, now this is D1, but I want the current dividend per share. Current dividend means D0. Okay, so I got D1. I want to calculate D0. So how? So because D1 is the dividend next year, okay, dividend for next year. So what I want is dividend this year, right? Because this is what I call as current dividend. Current dividend. So therefore, what's the formula to calculate D1? So you calculate D1, we use D0 bracket 1 plus G, right? So I can substitute in. So I can just write 3.25 equals to 0, 1 plus G. G is, what is the growth rate? G is capital gains, right? Because we talk about G is capital gains. So G is 5%. Okay, so 0.05. Okay, then you play around with the numbers. You will get D0 equals to 3.1. Okay, yep. Okay, let's move on to the next question. Okay, next one, to calculate growth rate. So now the stock price of Jenkins Co is 53. So current stock price P0. Investor require a 12% rate of return on similar stocks. Which require rate of return. If the company plans to pay a dividend of 2.85 next year, is the one. What growth rate is expected for the company stock price? This is easy also. You just calculate using the formula, right? So P0 equals to D1 as proportion of R minus G. Then you move around. Okay, so I move around. Okay. And then now can rewrite into D1 divided by P0. And then R plus G. Okay, so then I will calculate G1 0 uh, um, minus R. Okay, and G equals to R minus D1 or P0. So now I can substitute the numbers in. So required rate of return is how much? 12% minus D1. D1 is 2.85 divided by P0 is 53. Then you get the answers. So you're just playing the formulas only actually. Fun, right? So at the end you get 0.0662. So convert it to percentage, 6.62%. Okay, so I use this initial formula and then form this formula. Okay, next question. By the way, later I need your help to do TS for Intro to Finance. Haven't do yet, Intro to Finance. 还没有，我看到 Intro to Finance only 12 people did only, you know. Oh, thank you, thank you. Okay, next question. Valuation again. Olympic Sisters will pay a dividend of 2.6 next year. Okay, D1. The company has stated that it will maintain a constant growth rate of 4.5%. So easy, all these questions. Okay. A year forever. If you want a 15% of rate of return is R. Okay, how much will you pay for the stock? How much will you pay? Okay, what if you want a 10% rate of return? So another question. Okay, what does this tell you about the relationship between the required rate of return and stock price? So we learned that required rate of return and stock price is the negative relationship. Correct or not? Right? When the required rate of return is high, stock price will be low. We just learned from the graph just now. Correct? Okay, so now let's calculate. When I expect my required rate of return is 15%. Okay, so how do I do? P0 equals to D1 divided by R minus G. So D1 is 2.6. Required rate of return is 0.15, and then growth rate is 0.045. So you get 24.76. Okay. And another scenario, when the required rate of return is 10%, okay, same thing as well. P0 equals to 2.6 divided by 0.1 minus 0.045. Okay, and then you get 47.27. Okay, that's the answers for that questions. At the end, you can see the negative relationship. You can see that when the required rate of return is lower, okay, the share price will be higher. And when this is higher, then this will go lower. Okay, done. Need more time? Oh, good, huh? Next question, important questions. Okay, one must pay attention to this question. Okay, this one, last question. Everyone try to do first. See if we can get the answers or not. This exam question, huh? Okay, so BMW Limited is about to be listed on the share market. You determine that BMW required rate of return is 16.55%. So any apa? Any R. Today dividend is 1.1. Today's dividend is 0. Okay. And after analyzing their future prospect, you forecast the dividend in a year time will be 1.2. What is this? In a year time, D1. Very good. Okay. You expect this dividend to grow by 12% for the next 2 years. Okay. 12% for next 2 years. That means this one. Okay. And then settle down to a constant growth rate of 3% per annum forever. So that means after the 2 years, it will grow 3% forever. Okay. So what is the fair price? Fair price means share price. Okay, what is the share price of BMW? Okay, so what you need to calculate? You need to calculate this one. But what info you need? You need D1, you need D2, you need D3. And then because we know that after D3, it will grow at the same constant growth rate forever. So I need to combine together with P3 as well. Okay, and how do I get this P3? I get this P3 from the constant growth rate formula, okay, in which I discount all the dividends back to calculate the P3. Okay, so therefore, what are we calculating? So how many info do I need? I need D1, D2, D3, and this P3 to calculate my present value. So try and do that. Okay, we do step by step. D1 already got, so we calculate Okay, D1 I already got. I put 1.2. D2, use D1, 1 plus G. So 1.2 bracket 1 plus G. G is 12%. Okay, initially 12% first. So what do you get? You should get 1.344. Okay, then after that you calculate D3. Then you will get, let me know if the value is incorrect. 1.50528. So we have these three values already. Then I want to calculate P3. But P3, to calculate P3, I definitely need to get D4, right? So I calculate D4 to do first. Okay, D4, 1.50528 bracket 1 plus 0.12. Okay. So not 1.012, sorry, because from D4 onwards, from D4 is 3%. I say 3% already. The looper. Okay, so 0.03. Yeah. This is 1.5504. Okay. Why do I calculate D4? Because I want to calculate the P3. P3 equals to D4 as a proportion of R minus G. So D4 now I know is 1.5504. Proportion of required rate of return is, what's the required rate of return? Required 60.55%. This one, 0.55%. 655 minus growth rate. Growth rate is 3%. 11.44. So I got all the values that I highlight in blue already. Okay, then I can put into calculator. Okay, like you can see here. Okay, so press second clear work. CF0 equal to 0. Okay, C01, 1.2, frequency 1, C02, 1.344, C03, you combine the two together, 1.505 plus 11.44, and then press NPV, press interest rate, and then compute NPV. Then you get the answers, which is 10.2. That's the answer for these questions. Okay, so these are the things that you need to know for tutorial 7.